Why interest rates affect everything you buy. Interest rates are just a number, but that number affects your mortgage, your car payment, your credit card, and even the price of groceries. In this video, I'll explain how interest rates quietly shape the economy and why they matter to your everyday life in plain English. What interest rates are. Simple explanation. An interest rate is the cost of borrowing money. When you take out a loan, the bank charges interest on top of the amount you borrow. That extra cost is the interest rate. Central banks, like the Federal Reserve in the United States, influence interest rates across the economy. They raise rates when they want to slow things down. They lower rates when they want to encourage spending and borrowing. When interest rates change, they don't just affect banks. They affect almost every financial decision people and businesses make. Point 1. Higher interest rates make borrowing more expensive. When interest rates go up, loans cost more. This shows up quickly in real life. Mortgage payments rise. Car loans get more expensive. Credit card balances grow faster. For example, if interest rates rise by just 1%, a monthly mortgage payment can increase by hundreds of dollars. That extra money has to come from somewhere. Usually, it comes from cutting back on other spending. When millions of people do this at the same time, businesses feel it. Stores sell fewer items. Companies delay hiring. The economy slows down. Higher rates act like a brake on spending. Point 2. Lower interest rates. Encourage spending and investment. When interest rates are low, borrowing becomes cheaper. People are more likely to buy homes. Businesses are more likely to expand. Investors are more willing to take risks. Lower rates make monthly payments smaller. That frees up cash for other purchases. It also makes saving less attractive because savings accounts earn less interest. As a result, money moves through the economy faster. More spending leads to more jobs. More jobs lead to more income. Lower interest rates act like a gas pedal. Point 3. Interest rates affect prices. You don't expect interest rates even influence prices that don't seem related to loans. When borrowing is cheap, demand increases. More people buy homes. More people buy cars. More businesses compete for workers and materials. That increased demand can push prices higher. This is one reason inflation often follows long periods of low interest rates. On the other hand, when rates are high, demand slows. Prices stop rising as quickly. In some cases, prices can even fall. So even if you never take out a loan, interest rates still affect what you pay at the store. Brief historical context. Simple history shows how powerful interest rates can be. At times when inflation became a serious problem, central banks raised rates sharply to slow spending. This helped bring prices under control, but often caused recessions. During financial crises, interest rates were lowered to near zero. This helped stabilize economies and encourage recovery. These examples show that interest rates are a powerful tool. They can cool the economy or heat it up, but they always come with trade-offs. Interest rates may seem distant and technical, but they touch almost every part of daily life. They affect how much it costs to borrow money. They influence how much people spend or save. They shape prices, jobs, and economic growth. When you hear that interest rates are rising or falling, it's not just news for banks or investors. It's information that affects your budget, your future plans, and the overall economy. Understanding interest rates helps you better understand the world around you. If you want more clear explanations of how the economy works, consider subscribing for future videos.